This particular talk, Know Your Numbers, it's very important, obviously, but it's very important to me specifically because I think as I go and meet with a ton of different contractors all over the country, it doesn't matter if they're in California, New York, down to Florida, anywhere in between, I have been inside the doors of probably over 100 companies at this point, and I would say only one or two of them know their numbers, truly know their numbers, okay? So this is applicable for everybody, in my opinion. So I want to start off with a question. By the way, for those of you that have seen this before, if you've been at another event that I've spoke at or in general, there's some changes in here, so don't feel like you're going to get eyes glazed over the whole time. But I'm going to ask this question. I want to have some people raise some hands. What's the most important number to your business? Those that have not seen this before. Cash on hand? EBITDA. Who else? Anybody else? Revenue? That's the most common answer for those that just heard that, okay? Someone said EBITDA. Well, net profit, but for today's purposes, I'm going to talk about EBITDA because I'm not a tax guy, I'm not an accountant, I'm not a CPA, so my intention is to talk about everything that you can control, right? Certainly tax strategies and so forth, but I don't want to go into that. But yes, EBITDA, that is absolutely 100% the most important number in your business. And so I'm going to start off just to make sure we're on the same playing field here. What is net profit versus EBITDA? Net profit is revenue minus cost of goods sold minus operating expenses, other expenses minus the EDA. EDA stands for interest, taxes, depreciation, and amortization, okay? So net profit is what you really made after it's all said and done, okay? But EBITDA, which is used by a lot of financial institutions, a lot of brokers, a lot of PEs, et cetera, okay, as an indicator for good financial performance, the EBITDA revenue minus cost of goods sold minus operating expenses minus other expenses, what's missing? The interest, taxes, depreciation, amortization. Now, again, don't want to go too far down that road, but we're not necessarily talking about the taxes of like payroll taxes. Those are a part of the OPEX, okay? But the other items that are state, federal, or local county, those types of taxes, and then of course depreciation, amortization, and those types of things are accounted for at the end of the P&L, okay? So, as roofing contractors or contractors in general, I've seen it in all trades, there's a massive disconnect. I'm glad someone said revenue because that is the most common answer. Let me tell you something about revenue. Revenue is vanity. How many people know companies out there that are doing $20 million and they have a $500,000 net? There's more than what you realize. I know that there's some clients I work with that are in this room. I'm not going to name any names, okay? But they're like, man, I really don't like working for 2 points. I don't like it either. Okay? Revenue is vanity. I love this quote. This is not a quote. I wish I could coin this quote, but I heard it at a mastermind one time, and it was like, man, I just loved it. Okay? Revenue is vanity. Profit, sanity. Cash is reality, and energy is the real currency. Deshaun and I actually did a podcast a lot about energy last, 2 weeks ago? I think 2 weeks ago? So this man's got great energy. Energy is your real currency, right? And I think during my talk last night when we did our little fireside thing, it's something I got to do better about is protecting my energy. I think we all could do a better job of that, right? And that's something that is very key, which hopefully Deshaun hits on that a little bit today. I'm assuming he will, but my focus with you guys just specifically is about the profit and the cash, right? With this particular topic, okay? Profit is sanity. Cash is reality. We have credit lines, we have term loans, we have SBA, we have all these different things, but cash is the reality, right? Cash is cash. We need to make sure we're retaining cash, and we'll talk about that a little bit, okay? So the disconnect of that profit is that so many people focus on their revenue, and it's vanity. When was the last time you asked yourself this question? Have you ever thought about your net profit dollar target? Truthfully. Because not many people do. Not many people. Now, here's what I'll tell you. A lot of people go out and they say, oh, I want to be 10% net. That's good. Okay? Well, and generally speaking, that'd be pretty healthy in this industry. Okay? I'm not talking about the percentage. I want to know the exact dollar. And how does that convert when we're talking about our goals as a company. And I'm going to outline what those goals should be here in just a second, okay? Mentioned this already. Most contractors have revenue targets. Very few have profit targets. Why is this? You just don't know what you don't know. You've been focused on what everybody else is doing, the big trucks, the big, the loudness of everything that exists inside this industry, and you associate that with revenue. I know a lot of guys that do $7 or $8 million. I say a lot of guys in the minority, if that makes sense, that do $8 or $9 million, and their freaking EBITDA was 2, which may not even seem plausible to some of us. Certainly, market conditions make it a circumstance, right? It's hard to be a 70% or 60% gross profitable business in insurance space, let's say, okay? But a lot of those people, that's why I was talking about that sweet spot earlier, right? They like that sweet spot. They're in a really good place, okay? And they're really focused on profitability rather than top line. So as we journey through this concept today, the biggest question mark that exists and what is happening inside of a business, especially in our space, but this is industry agnostic, okay, is gross revenue to net profit. It's simply a math equation. And I'm sure a lot of us know that. But what happens inside of there, it's where business is done. So compounding on what I talked about earlier and all the things we've already discussed today with these incredible speakers, laying in that foundation, having great people and operational processes and production and sales and marketing and all these things, this is all determining factors of how well that math equation works out. Because again, the goal, and I draw this out on my on-sites on sheets of paper, I go through all that stuff nonstop, and it's like, it's a funnel. You start out at the top with this, dollar figure, 100% of the monies that you bring in, right? How can I get to the bottom as quick as possible with maintaining great profitability? And that's the key, right? So let's work backwards. I said I'd give you some examples. This is how I do things, okay? This isn't the Bible of finance, but it's something that I would certainly consider if you're looking at a situation that you're unfamiliar with when it comes to finance, which is how do I even generate a net profit target? So how do we do this? Well, through 4 things. How many of us are in business, and it's okay, we're in business to make impact and those types of things. How many of us are in business to make a profit? Okay? So that would be in retained earnings theory, okay? And for us individually, how much of us are in business to earn a living individually? That would be called dividends, okay? As an owner, you pay yourself a salary, and as you, just like if you play in the public markets, right, what do? Based on the profitability of the company, typically quarterly, you own, 0.0001% of Apple, and they're going to give you a dividend, right? That's what a dividend is. You're a stakeholder, right? Team incentives. Have any of you thought about doing great trips or retreat outings or things like that, right? I think that's a new concept that's been coming into this space, and I love it, about doing a lot of things that can increase the team morale and be able to invest back into our teams, into our people. So team incentives, that's something that also I like to think about it, y'all. You can create team incentives, and that other part, which is that charitable giving piece, okay? Those are what create a common mission, right? How many people want to get rallied around their own financial well-being? Quite a few people, I would imagine, right? Yeah, I saw Anthony's hand go up. He does a lot of that stuff with rewarding his employees. But, okay, charitable giving is the other thing. What can I do outside the walls of my business, right? And it doesn't have to necessarily be a charity per se, but giving, right, of any sort. Create common mission between those two things, and you're sitting there going, well, profit target. How would I get a team corralled around a profit target? That's not really something that I feel comfortable to share, that we got $1 million left in the bank. No. It converts to your revenue, which we're talking about. This is what I'm talking about, working backwards, okay? So in a second, when you start with that profit target, instead of going, hey, I want to hit $10 million revenue, how many people right now, be honest, have come up with a revenue target because they want to double what they did last year? It's okay. Raise your hand. It's okay. Great. Thank you for being honest. Most of you probably are doing that, but didn't raise your hand. It's okay. Okay, the reason is because we just don't know what we don't know, right? But if we understand how the financial pieces of this work, it creates so much clarity across the entire organization, okay? Last thing I hit there is, inside that retained earnings piece, okay, it's important to hold cash on hand. Again, I mentioned this earlier. Cash is reality. You should try to attain 6 months OPEX in the business, okay? So if you're running a $50,000 a month overhead, you need to try to get to $300,000 in your bank of free and clear cash as quickly as possible, okay? Now, the caveats to that are once we start getting to a certain size with that bank account, okay, then there's other options, maybe not in this market currently, but to diversify ourselves to let that money work for us a little bit differently, okay? But by and large, I'm a big proponent of like holding some warranty so that in case you have anything that happens that you're pulling from a different set of funds than you are from an operating. And then also making sure that you have a reserve account, okay? But I don't want to go too deep in that. The point is maintaining 6 months is healthy. Private equity loves 6 months because it shows that you've been healthy enough and you've been financially aware enough to know that market circumstances are different and things are a little bit more volatile at this moment. And 6 months is you can do a lot with 6 months of free and clear cash, right? There's a lot of mistakes that can happen or things that can happen, especially when they do mergers and acquisitions. There's usually a 90-day period of just absolute chaos anyway, right? And they want to know there's good money in the business, okay? So working backwards. This is where this is all going to come down to the rubber meeting the road. So I came up for the purpose of this exercise. The formula is up top, by the way, okay? But this example, on an annual basis, the $100,000 of profit target, okay? Just making it simple. And I had a guy actually one time speaking. He's like, how are you getting 35% GPM? Guys, just bear with me. 35 should be a number you should be able to achieve. But if it isn't necessarily for your circumstance, then just roll along with the example here. But $100,000 of profit target, okay? What do you think we're going to do? We're adding our expenses to that. We're going to multiply this basically 100 over your percentage, okay, to be able to get a gross revenue target of $1.74 million off of that original $100,000 profit target that we set. Is this making sense? Anybody have questions about this? Because this is absolutely crucial. Now you're probably wondering, how does that formula work out? Whatever. Don't worry about that. Just trust that the formula works, and it's exactly how it works mathematically. Okay? Does anybody have any questions on this? Okay. So if you can understand the power behind understanding what you want to what you want, right? It goes back to what you want. Profit target is provides a lot more clarity for that gross revenue target to be very clear for everybody else, because then you know exactly where you're headed, exactly where you're going, okay? So, clarity through numbers. Now we understand the true numbers of our business, rather than just going, hey, I did $1 million last year, I did $2 million this year, I did $10 million last year, I did $15 million this year, whatever, okay? Now we actually understand how the numbers work inside your business. And so if you don't know some of these abbreviations here, COGS, cost of goods sold, GPM, gross profit margin, okay? OPEX, operating expense, CAPEX, capital expenditures, okay? If you understand your numbers, it'll tell you everything about your business. I know I'm probably talking in some layman terms to some folks that already understand this concept, but it's very important to understand your break even. How many people know their break even right now? Okay, 2. If you don't know your break even, when you start putting deposits in that Chase account or that Wells Fargo, how in the hell you know whether or not you're actually in profit? You have to know where you're at. Gross burn rate. This terminology, so I want to make sure everybody understands break even. I'm going to give an example here in just a second, but gross profit minus gross burn rate. Okay, what is gross burn rate? Monthly recurring operating expenses, payroll, rent, utilities, recurring, all necessary expenses to the business. If you strip back all the things that were unnecessary in your expending, what would your break even be? Okay, so using an example of $100,000 of gross revenue at 35% gross margin, what does that mean? We're left with 35% gross profit. 35% gross profit minus that 35% gross burn rate. If I were to say that that's how much my business was spending on a month-to-month basis, that would be my break even, right? $100,000 of revenue if I knew my 35% gross margin was the case, okay? So a quicker math equation, if you understand gross burn rate and GPM, if you do not know either of those, start there. Those are one of my two most critical metrics to understand inside your business. So if you can understand those two things, you can create a lot more predictability and not go into a position where you're like, why am I losing money? I don't understand it. Or why have I gotten into this position I'm in, right? So if you want to take out a calculator and try this, okay, I want everybody to do this together so you understand this. It's a very simple concept. Take out a calculator. So I want everybody to do this example, okay, of a $50,000 burn rate on a 40% gross profit margin. I want you to read that equation. I want you to tell me what that break even is. Who's ready? Just speak up. 125. 125. Does everybody know where we got that? So, gross burn rate, 50,000. Divided by GPM in decibel form. So if you're running 40%, that'd be 0.4. For those of us that have been out of school for a minute. Gross revenue needed to break even. $125,000. It's that simple to understand it if you know your numbers. It's vitally important because the last few months, very, very transparently, I am not perfect. And my business is not perfect. I sold a company, I did a merger back in 2020, and then started up something again in like basically April of this last year. And we came in the slow season, and I started seeing the bank account. I saw the deposits not as high as what they normally are. How many of us have felt that way this season? Okay? And so as they were not as high, I'm sitting there, I'm going, I know we're not there. I know we're not there. I know we're not there. Because I know, I'm seeing it. So I was able to see it enough to be able to go, okay, this is coming, right? Before we got there and we're like, oh, we're defaulted on this SRS account. We're defaulted on this, right? I knew it for a few months, right? Okay, so highly, highly important if you get nothing else today that you understand that. Is everybody pull out a calculator, is there anybody that missed that concept? Okay. I'm going to break down a chart of accounts for you, which you might sit here and literally fall asleep as I do this, but I want to make sure that people have the opportunity to understand what these categories mean. Cost of goods sold, also known as a variable expense. OPEX, also known as a fixed expense. CapEx, also a fixed expense, but a little different in the fact that it's more of a depreciable item. Okay? There's tax benefits to buying equipment, buying trucks, doing those types of things, putting vehicle wraps in place, et cetera, okay? And loans are a little bit different. That falls on the balance sheet, so I don't want to talk about that. But other than that, you've got some other expenses, right? Okay, cost of goods sold, OPEX, CapEx. These are kind of the categories. And OPEX and CapEx and others all categorize these expenses. So I want to make sure I'm being very clear because I'm about to talk about this in a second. Cost of goods sold is the only above the line piece, right? Everything else is still below the line in terms of a P&L standpoint, but it's very critical. And I only know this because I've had some people recently that have gone, I know they're laughing, so they got out of themselves already. But folks that I'm working with that I said, hey, like, you understand your tax liabilities and things that are happening. If you don't have things journaled correctly, you can be hurting yourself significantly. And CPAs, I'm not there to knock them because I think they're great, but most CPAs are not the best bookkeepers, and nor do they understand the repercussions of the way that you journal things in this industry. So you got to get with somebody that understands that, okay? And if you want to take it upon yourself to understand that, great, but you're going to need a little bit of time if you're starting from scratch, okay? This is the example that I'm carrying over. $1.7 million goal. Remember that was our goal from earlier, right? Okay, 1.714. If I understand my average job size is $15,000, closing ratio at 35%, and we know that we work 50 weeks out of the year. Okay? What's that going to tell you? Some pretty good information. There's a caveat to this. Not every month's created equal, right? For most of us. Now, if you work in Florida and you got sunshine 12 months out of the year, I got to grab water over here. Gross revenue target that I just provided to you earlier, and I said, hey, January, historically speaking, there's other things we can do in the financial world. I don't want to make things complex, but we consider standard deviations and all these different things that we can do to financial model, okay? But the idea is we want to use something. We want to use some data to be able to understand more predictability, right? That $1.7 million business, or that revenue target we have rather, $56,000 this month. That's how it works out, okay? If you understand things that way. So what do you think happens when you do that? You then create sales targets, you create spiffs, you create all these other different opportunities that if you continue to stay on course and you're hitting those numbers in the way that you see it historically, then you can create, again, what did we talk about earlier? Predictability, predictability, predictability. Okay, that's what it's all about. This is something that's a little new that I introduced on this time around. So if you've seen this before, you haven't seen this before. If that even makes sense. $100,000 of cash on hand, $50,000 of deposits on hand for this example, okay? I'm going to go ahead and pull everything up, or pull at least those two things up to start, okay? And then we've got $100,000 of AR total and $50,000 of AP total. How many people know all four of those metrics right now? Okay. Well, let me tell you something right now. That if you know that, when I told you earlier, when you keep that data and you understand what that data is, I can tell you the health of your business in about 5 seconds. This is one of those things. Because if I understand your real cash on hand, which is why I pulled from up top, right? So these are, just make sure I'm not twisting people up because it's kind of hard to explain on a PowerPoint. Okay, this is one equation. This is another equation. I'm going to come back to the equation in just a second, but if I understand the real cash on hand and my positive AR ratio, I can understand a projected operating capital pretty well. Right? Why is that? I want someone to share with me why deposits on hand is important to understand when we're talking about our real cash on hand. Can someone tell me? Correct. There are costs that have not incurred a what? Or cash, rather, certainly not costs. Cash that have not incurred a what? They have not. First checks, whatever, okay? And some of you might go, well, I don't collect deposits. But you probably should. But if you're not, you might not have as much of an issue with this. But if you do, you definitely need to know this. Because we don't like playing, robbing Peter to pay Paul, okay? That's the old style of doing roofing. ARAP. Who knows this ratio? You should. If you don't know this ratio, boy, we need to know that. So ARAP, what does this mean? Just someone stand up with this particular scenario, with this particular equation. What does that mean? I understand. I'm saying, what does that $50,000 mean? $50,000 in the clear on the ARAP rate setup, right? On an ARAP difference. I have $100,000 of AR, accounts receivable, what's to be collected, accounts payable, what's to be paid, okay, is $50,000. That means I should be somewhere in the neighborhood of $50,000 right side up, right? Okay. So in an equation like this, and hang on to the people that are the accountants and smart financial wizards here just a second because I'm about to come back to probably what you're thinking in this equation, okay? But for the time being, if I did not know my gross profit margin, I would at least have some sort of understanding of where my business is. Would you guys agree? Yeah. So then we add in the element of, this is the bonus. Now I know I got that 35%, like I was telling you about earlier. Remember our earlier equation where we did that and we divided it by 35% because we were doing that $1.7 million deal? Now what's our new real cash on hand total? Why is that? Because you know your margin, so you know roughly how much of that money should be your money. Make sense? So what do? We factor that back into that cost of goods sold, or cost of goods sold incurred cash, that real cash on hand. Now that's $67,500. So we just allotted ourselves another $17,500 because we knew that. So how does that affect the rest of this equation? Well, now my new POC is $117,500. Now for some of us, and again in this equation, $100 grand, that ain't a big deal. Okay, but we're talking about $10 million of revenue or $100 million of revenue or whatever the case is, or even if it is this scenario, because everything's very, very relative. Even us that have $1 million or $2 million company, we still, it's a lot of things are very relative. Okay, things are very, very dependent on the circumstances. Okay, but 117.5. Now I know I should have another 17.5 in there, right? In that projected operating capital. Okay. So P&L and review. I've done these on an on-site. I've never done it here before, but I just feel like I need to make sure everybody's clear and on the same page. What is this? I already told you the answer, but what is this? Huh? It's profit and loss. It's a P&L. It's an income statement. Okay? In the accounting world, we call it P&L now with QuickBooks, but above the line and below the line. That's what I meant by that. Okay? So if you're not used to knowing accounting or looking at a P&L, which I would challenge you to read and look at on a regular basis once you get your numbers right, because it'll tell you a lot of things about your business, above the line and below the line, just to make sure everybody's on the same page. I am very, very, very concerned with above the line being a percentage-based goal. Hang with me here. Below the line, I am very concerned with it being a physical cash goal, or not goal, but metric, rather, let's call it, okay? So a percentage metric and a cash metric. Why do you think that is?
Because the top's real numbers.
Yes, but not what I was looking for. Anybody else? Because if I do $500,000 in revenue in 1 month around a $50,000 overhead, what is that overhead percentage? 10%. What if the next month I do $250,000, I have the same $50,000 overhead? It's 20%. Changes things. The 10-50-50 is not a thing, if you wanted to know, newsflash. Okay? Because there is no such thing as the 10-50-50, because every business's overhead is built upon what is left to be had from gross profit. And depending upon how well you want to be doing for yourself with your cars and your vacations and paying yourself or whatever else you want, okay? But it has so much to do with the circumstances of how the money works. Variable expenses are probably going to go up as your revenue goes up. You can have more buying power. You can get materials less. You can buy down your labor here or there, whatever, okay? I would encourage not to do that as much, but you can do things, but by and large, and I didn't create this graph, but revenue and cost of goods sold are going to trail pretty consistently, okay? The fixed thing, remember what I was talking about earlier, and I don't have my whiteboard up here, or else I'd go on another tangent, okay? A lot of you have seen me run out the exercise of where is the sweet spot. Identifying your sweet spot is when when net profit increases and your EBITDA increases, as you start getting into that position of doing more revenue and your fixed expenses don't travel as quickly behind. Because the more that you keep doing that with it, the more consistent your bottom line is going to get, right? We want to try to maintain as healthy of a bottom line as possible. But again, who's in business to make a profit? I just asked you those questions earlier, right? Okay, so we should be concerned with that. We should be concerned with understanding the dollars, the physical dollars on the fixed side of things, right? Not a percentage, not a 10% overhead, not a 15% overhead. Understanding the dollar, okay? So this is a P&L, as I mentioned, okay? So getting through, when I did the two red lines, it was basically like, that's above the line, below the line. And then again, talking back to what we talked about a minute ago, EBITDA is what we typically recognize as profit, and net profit's the actual profit, right? That's a simplified version of a breakdown on a P&L, okay? Cash versus accrual. I'm going to talk about this for just 2 seconds. One of my biggest pain points for me personally is I go into contracting companies and they think that what their CRM is telling them is accurate when it comes to their accrual-based accounting, because very, very few keep track of that on a QuickBooks basis or on an actual bookkeeping basis, okay? Most of you are doing syncs that tells you I've got X amount of dollars in the bank, in theory, in an AR scenario, okay? And I'm not going to get into deposit invoicing, all these different things, but if you do not understand truthfully your AR and AP, you will run into problems. And I've had like 10 head nods just then, because you've probably experienced that. Okay? I'm not saying CRMs aren't great. I'm not saying QuickBooks syncs can't be great. I'm saying garbage in, garbage out. So try to do your best with understanding or getting with somebody that understands how to really know the difference between what is truly your accrual and what is your cash. Because what I always tell people is I say, there's this like third thing in the middle that exists inside our industry. Cash and accrual, those are the only two options. But we have this like fake accrual, which is that we think that we have the AR that the CRM is telling us per se. We look at a report or something, oh yeah, we got 300,000 in the bank. Well, what you didn't do is you didn't run a deposit invoice, or you didn't log something in the deal that says that you received that payment, right? And all of a sudden, I can't tell you how many times I've gone in, oh yeah, 350 in the AR, and then I'm like, well, we reconcile, it's 200. That's a big damn difference, right? So cash versus accrual, if you're still with me here, okay, cash, and I'm going to talk about the definition in 2 seconds, but cash is king. So manage cash in, cash out first before you start worrying about all this other, complex stuff and all these other things that I've already said today. Okay, these things are important, but if anything, master the element of cash in, cash out. Get better at predicting cash that's going to come in and better at predicting the cash that's going to go back out, and constantly keeping that in check, right? Cash-basis accounting is when revenues are actually recognized and expenses are recognized at the time that they are received or paid out. Accrual is when the income at the time of the revenue is earned and records expenses, which is very rare for our business to be doing that, but when the liabilities are incurred, right? So when the revenue and the liabilities are incurred, that's accrual, regardless of when the cash is received or paid, okay? So I just want to make sure that you guys know the difference between those two, and you should absolutely be running your business on an accrual basis when you get to the point where you master your cash in and cash out. Okay? So, create a legacy. Build a sell, build a scale, lifestyle, right? These are not just the 4. You could dive into a lot of different elements of this, like what's your succession plan, right? Okay? But it is inevitable. Every company is going to have an exit. It's all going to end at some point. So you should be thinking about what you want to create. What are you trying to achieve? Especially if you're in those, later years. Sorry for my French of those that are a little older than the rest, okay? But you got to be thinking about it. You got to be thinking about what is the ultimate exit for you. These are key exit metrics that private equity, merger acquisition space, and anybody that's going to go in and look to purchase a company, what they're looking for. This isn't just subject to this list, okay? There are certainly other circumstances, but your multiple will increase with a healthier EBITDA, and that will be based on percentage a lot of times. Leadership team and infrastructure in place. Proprietary matters, technology adoptions, operating systems, which we just talked about a little bit ago, okay? Having a language that everybody speaks inside the organization. And then if you're doing more than 8 figures, into the 8-figure plus world, you're going to usually demand a higher multiple, okay? In our industry right now, you're seeing, historically speaking, it's been like a 1.8 to a 2.8, and it's adjusted up because of all the things that obviously we're all seeing, which is how many of us get calls or emails from a broker going, I'm interested in buying your company, okay? If it's not happening now, it's going to happen soon, because people are looking at micro consolidations and larger consolidations and adding it to their portfolio, because they know that this business, albeit what those people don't know is very people oriented, okay? It's a lot different than a lot of other sectors, but they know that it's recession proof. They know that it's COVID proof. They know that, right, it's a good piece of the portfolio, okay? So right now, they're paying between 3 to 5x, and sometimes higher. There's been some companies that I heard of one the other day. It's happened a little while ago. I'm not going to mention the name because I don't think it's public information, but got paid an 8.5x. And let me tell you, his EBITDA was healthy, and he made a lot of money. Okay, so it's very achievable if you want to have this type of exit. Doesn't have to be this type of exit. Just saying it's very achievable, especially right now. A lot of money on the sidelines. A lot of money pulled out of the market because of the volatility right now. That money's sitting on the sidelines, and those big money spenders, they want to put it back in the market. They want to buy companies. They want to add things to their portfolios right now, okay? So $500,000 EBITDA at 3.5%, 3.5 multiple. In that example earlier, I guess the EBITDA was 100 then, but for this example, $500,000 EBITDA on a 3.5 being conservative, you're going to get a $1.7 million payout. This is truthfully where you separate yourself from the rest, because it's a freaking science and math experiment, and all I do is pull levers. And there's certainly levels to entrepreneurship. And I talk about people that, they're just getting their toe in. We all started somewhere, right? I mean the same thing. I put my toe in the water, and I was like, man, am I worthy of it? Am I able to do it? Whatever, okay? And you have that person, right? That's like, then they hop off the corporate wagon like I did, okay? And then you get someone in there that's like, oh, I don't really know. If I pull this lever, I don't know what's going to happen, whatever, okay? This is how you get to that position of a high-level entrepreneur where you're pulling levers, you know exactly what's going to happen. That's the difference between the greats. The greatest entrepreneurs, they predict and they know exactly what's going to happen, because as soon as they pull that lever, they know exactly what's going to happen. Last thing I'll say, as I put this up earlier before for the last one, okay, if you missed out on the opportunity, you're like, man, this guy's full of garbage on the last one, you feel maybe I enlightened you a little bit here, then you can scan it again, okay? You can also scan and get this deck as well. If you're interested in setting up on the 90 software, as I mentioned earlier, you can certainly do that there as well. And then, if you want a copy of the deck, if you want to meet with me one-on-one. So, okay? Appreciate you guys. Appreciate it. Love you guys. Appreciate it.